Retention is often the overlooked component of startup growth, but it's probably one of the most important. And today we're going to just do a super deep dive into a whole bunch of themes around retention. We're going to talk about product market fit. We're going to talk about core and proxy metrics. We're going to get into a little bit of how to think about product strategy as it relates to metrics. And we'll kind of go from there. So I'm going to move quickly. Again, the goal here is to provide you with as much context on some of these themes as possible. There's a whole bunch of additional material in Lifter LMS inside of WordPress that you all have access to. And I do encourage you to reach out to me and the team with any questions that you have as you're building your retention models. Hopefully by the end of today's session, you'll understand kind of how we think about retention at GrowthU and how we kind of look at it, like kind of the lens that we approach retention with. And including when we're communicating with our investors, we have a very retention focused set of messaging that we put out there, and retention is one of the key drivers of our business. So today we're going to cover an overview of this, what core and proxy metrics are, how to understand if you've got product market fit, cohorts. We're going to look at charting retention, impacts on retention by source and channel, and then finally on how to improve retention. And we're going to start with the definition. So what is retention? This is basically a measurement of how long your users stick around and are actually active and engaging with your business. It's very, very simple, right? Are they still around? Are they engaging with you? And I would argue that this is probably the most important metric of any business, regardless of your model, whether you're transactional, subscription, consumer, a marketplace. If you can't keep users around, then you'll get into trouble relatively quickly. Even transactional businesses, even consumer transactional businesses think about retention, but the way that they model and measure it is a little bit differently than a traditional SaaS company, for example. So a retention rate, the definition of a retention rate is basically how you look at users who are still active after a certain amount of time. And so it's basically total number of users that came in within a period of time by the number of active after a certain amount of time. And what we mean by active is that the user is doing something that translates to how you define retention. And again, this may be different based on what your business is. So this could be that somebody came in and read an article this month, or that they purchased something this month, or that they subscribed to something, or they did something within the product. That means that they stuck around and they're still a user. Now, we're typically going to look at retention. You will usually look at it monthly. We'll look at it kind of twice a year, and we'll also look at it annually. Maybe you'll look at it quarterly as well. So for example, subscribers in your product may continue paying month to month for a year, or in a transactional model, maybe a user purchases more than 4 times in 6 months. And that's how you define what your core retention rate is. Maybe if you're an e-commerce company, for example, or maybe that a user logs in more than 1 time per month, each month for more than 6 months. And that's how you define what retention might look like. Now, Netflix is often considered kind of probably the most famous case. They've got absolutely stunningly amazing retention. Gibson Biddle, who is a longtime product manager there, basically had this to say: in the early days of Netflix product retention, roughly 10% of members churned, fancy way of saying canceled, each month. So 10%. In 2005, close to 5% churned each month. So they cut that in half. And today it's somewhere between 2 and 2.5%, which is just absolutely phenomenal. This is one of the reasons why they can spend so much money on content production, because they know if they can get users to stick around, and they can get them engaged, and I'll show you kind of how they think about this in a little bit, that they're going to make a lot of money off those users. So again, retention is going to vary widely based on industry type, pricing strategy, but there are some benchmarks. So this is looking at a 6-month retention window. So at the end of 6 months, you look back and you measure, what was my retention rate? So for consumer social products, good to great 6-month retention is that you have 25 to 45% of your users still sticking around, which doesn't seem like a lot, right? That means you churned 55 to 75% of your users, but that's actually normal. For consumer transactional, 30 to 50% are still around after 6 months. Consumer SaaS, 40 to 70%. So the Miros of the world, kind of non-enterprise level. Mid-market SMB, 60 to 80% will stick around. And finally, enterprise, 70 to 90% of your deals will, of your users will still be around after 6 months. Lenny Rachowski and Casey Winters had a great article on this. If you haven't read it, just look it up or ping me. We'll share it after. Now, why is this important? Why should you care about retention? Because even with great acquisition and amazing activation and onboarding, poor retention will kill your business. And so again, just this concept of a leaky bucket, getting users in, you may become amazing at acquisition, but if you can't keep those users around, then you're going to constantly go back to the top and spend more money and more time and more effort and energy to acquire those customers over and over again. Retention is just such a big player here. So what is churn? Churn, by definition, is the number or percentage of people who no longer use your product, but it's defined by your activity metric. So common measures of churn would be that if a user unsubscribes, if a user doesn't purchase again within a certain time period, if they were a paying member and now they're not, a user doesn't open your app, or maybe they don't listen to your podcast episode, or whatever your industry is, like there's going to be some interval that if they don't go and do the thing that you wanted them to do, they're considered churn, and you have to be kind of honest about how you look at that. Now, when we think about churn and kind of different retention scenarios, here's two different companies. Company one had 1,000 new subscribers per month come in, and you can see that they have a 90% retention rate. Company two had 2,000 users a month come in, and they had a 50% retention rate. And at the end of the year, company one spent $120,000 on marketing and made $554,000 in revenue. So basically they had $320,000 of revenue to play with. But company two, because the retention was so much lower in this model, same price, by the way, their cost was $240,000 to acquire the same number of customers to drive the growth, and their revenue was $440,000. So it's a difference of $200K. This has a very, very material impact on your profit and loss. So when you're building your longer term forward-looking financial and growth models, you do need to start factoring in retention and that retention interval as an honest indicator of what some of that P&L is actually going to look like. And that retention plays a key role there. But it's not just about kind of this core theme of retention. So one of the things that investors love is, and also startup operators who've run kind of revenue models love, is a concept called net revenue retention. So net revenue retention is basically total revenue coming in minus churn plus any revenue expansion. So you have a cohort of users that come in, and what you do is over the course of the year, you'll subtract out any of the churn, but you'll add in any of the upsells and cross-sells that you applied to that same cohort that came in a year ago. And you look at this monthly or annually. It's a fairly advanced concept, but basically it looks something like this, where you have total revenue from July 2019, that cohort of users that came in. Let's say you closed $8,000 in subscription revenue or in transactional revenue in July 2019. By July 20, that same cohort who started a year ago now produced $9,000 in revenue. You've got net revenue retention of 113%. It's above 100. From August 19 to August 20, you have 10,000 going up to 13. And again, you're subtracting out churn, but you're adding in upsells and cross-sells. You have 130% net revenue retention. Those of you that are involved in the stock market or do early stage investing, these metrics actually are super interesting to look at, and they generally will give you a sense of how strong is the business, even from an early stage. Generally need a year and a half of data on this. Now, why is this important? And this is a quote from Lighter Capital. NRR is perhaps the most important fundamental KPI in terms of determining customer success with your product. If you're a highly successful company with happy customers, your NRR will most likely exceed 100. If you're closer to 0, it's time to start taking a serious look at where your customers are churning out and take evasive action. Okay, so that was just a fascinating quote that I found from Lighter Capital on a metric that even a few years ago, I didn't even really know what it was. It was really, once I started getting into kind of running SaaS-based kind of high growth startups, that you start to think about this, and it becomes apparent how important it is. The other side of the coin is what's called gross revenue retention, or GRR. This is total revenue not including expansion. So this is going to be, you're going to subtract out your churn, but you don't get the benefit in this model of adding in your upsells and cross sells. So if you had somebody a year ago that came in $100 a month and you sold them 8 months in on $150 a month, you have a $50 increase in revenue for that customer. That doesn't get lumped into this calculation. So this is between 0 and 100. Now, higher percentage here means that you've got higher core retention, meaning you could be amazing at upselling and cross-selling, but still have a retention problem. You still have that top of funnel, a bit of a leaky bucket problem at that case. So with low GR, if NRR is high, means that, again, you've got probably an imbalance there where you're acquiring customers that, yes, you're able to upsell, but a large portion of them still end up churning out. The classic case here is if you sign up 50 customers and 40 go away and 5 of them become big clients, is that the type of imbalance that you want in your model? So these are some things that you want to think about as you go. And to chart it out here, again, this always decreases from year to year. So I'm looking at July 2019 and August 2019. You can see July 19 to July 20, we had an 88%. This is a typo. That should be GRR. Actually, we have an 88% GRR retention metric and a 70% in the subsequent month. All right. So basically, this will just give you another set of metrics that you're going to look at. Again, this will happen at about a year of tracking the data. Here's a side by side. I'm not going to spend a lot of time here. The next thing I want to think through and talk about a little bit are core and proxy metrics. And so for those of you who don't yet have a retention model, that's totally okay. In fact, in a lot of ways, we're still building ours at GrowthU because these things take a while to build. What you want to understand is, what is that core retention metric going to be? And you want to build what's called at least one proxy metric that you think is going to impact retention. And so when we look at this, so your core retention metrics are, again, they're these higher level kind of business level impactful metrics. What are you going to base the success or failure of your model on? And so here's some examples. Netflix, their core retention metric would be monthly active subs. For us, it's number of active members, and we count that either as an annual or a monthly membership. For Zoom, I don't have inside data on this, but I think it's around monthly paying users. Again, some kind of subscription metric. For Sandbox, which is a consumer-focused startup with a transactional business model, our core retention metrics was average revenue per user and LTV. So the lifetime of the customer, the revenue over the lifetime of the customer is what we ended up figuring out as kind of our core metric. But just remember that this may take you quite a while to figure out. You need at least 3 months, 6 months, 12 months of data. So in between, when you're thinking about what that metric is going to be for retention, you still want to influence your retention model. You still want to figure out the ways to acquire and retain those users for longer periods of time. And the way you do this is by looking at these proxy metrics. So the proxy metric is the metric that you're going to use to measure how likely it is that a user is going to positively impact, or a user action is going to positively impact that core retention metric. This will make sense, I think, when you see it. So for Netflix, it is now known that if they get users to spend 19 hours of content per month, that user will not go away, right? So it took them a little while to figure this out. You can actually read about this in some of the public filings, as well as if you follow folks like Gibson Biddle. He talks about a lot about this, like in his newsletter and stuff. But like, they learned if we can just get somebody in and consuming that 19 hours of content, they're going to stick around. For us, if we can basically have 3 what we call points of engagement with our members or our students over the course of a month, we generally know they're not going to churn. You're not going to churn. With Zoom, I believe the proxy metric is that if they can get the free users to set up calls more than once per week for some amount of time, they'll likely stick around, and they'll likely become paying users that stick around. And for Sandbox, we learned that if we could get somebody to, in our platform, write a letter and send more than 2 letters in their first week, that was going to lead to a much higher chance that they're going to stick around and be much more of a lifetime member. So these are very potentially short-term views of user behavior in your product that lead to future retention or future churn. So in the case of Netflix, if they run some promotion and onboard a whole bunch of users that on average only spend 2 hours a month in the product, right? Use Squid Games as an example. Let's say they onboarded 50 million new users and users got through 2 episodes of Squid Games and then they stopped because maybe they didn't like it or whatever, and they didn't get exposed to all the other content. Well, that's going to become a churn problem really quickly because they didn't hit that proxy metric interval. Okay. You have this in your business, and this is a leading indicator of success for your model. And you can use this as an early gauge to understand what channels are working, what experiments are working, and kind of that cohort fit against your long-term core metric. And just know that there might be more than one of these proxy metrics over time, and it could in fact change. So the reason why I think this is important is not only does that give you a sense of what does future retention look like? How do I build that into my model? And what are the things that I can do today to influence those user metrics that impact retention? Because we know we're going to look at retention as a long-term thing. The other area of value is around product market fit. And so with product market fit, basically my definition of product market fit is basically when you see the proxy metrics on a chart flatten within 6 months. And I'll show you some screenshots of what this looks like. But product market fit is really just a measure of revenue or some user growth metric against the payback period. And you're going to use that proxy metric to measure this. And what you want to do is understand what percentage of your users in your product right now are finding value in that product over a predetermined amount of time. And again, this is going to vary based on your industry and your product and your model and all that stuff. But this is really all it is. But when you understand when you're approaching or when you've reached or when you haven't reached product market fit, when you understand these things, you can start to think about scaling, spending more money on growth, having more confidence in your ability to predict your financials. You'll have much more confidence in your retention models. And the way that I'll often look at this is through a set of these kind of like these burn down graphs, basically, where you take an interval of time. In this case, it's 12 months. So on the bottom, we're kind of looking at month 0 through month 12. And on the top left, what we're looking at is the percentage of users that are quote unquote activated. This is a generic example, but it's meant to illustrate that you could use this for any concept. So the users activated is that proxy metric. So if I'm looking at this through the lens of Netflix or through the lens of GrowthU, I'm saying, well, of the members or subscribers who started last January, what percentage of them are still consuming 19 hours of content or having 3 points of engagement with the team or on sessions month to month to month to month? And does that fully drop off and hit 0 over some amount of time? If it does, then you probably don't have product market fit, right? So users falling off that core action means that they end up just going away. And if you never flatten that curve, what it means is that you start and at some point in the near future, you don't have any users left from that original cohort that signed up. So that's a sign of poor retention. This is also super common for those of us just getting started. Like if you plot your action metric and it looks like this, and you're like, oh God, this is a disaster. Give it some time, and we'll get into ways that you can increase retention as we go later on today. But then what you often will see is, okay, well, January was like basically you hit rock bottom here, kind of like in month, I don't know, 7 or 8. By February, like we actually don't hit 0, meaning that the users that we acquired in February, 12 months later, roughly 15% of them are still around doing that core action. So again, if I'm Netflix, 12 months later, 18 or 15% of them are still consuming 19 hours of content. And therefore they are the ones that haven't gone away. All the people that went away are the ones that are not consuming the content, which is what we're plotting in this curve. So here we're doing a little bit better, and we still have this sharp slope and it never really flattens. So we're still pre-product market fit. Now, if you see, like, let's say March comes along and maybe you change something with your onboarding or you change your pricing or you change your activation strategy and you get those users to consume more of that core action that you need them to consume, and this curve flattens off around 6 months or before, that's generally an indicator that you've got some level of product market fit. Yes, you want to bring this line up over time, but if the curve flattens, it means that like for the percentage of people that started in March, you had 100% that started in March, you still have 40-ish% of them in, 6 months later, you're doing something right. And what you do is you go through an exercise of kind of plotting this over time. And that's generally an indicator of product market fit, meaning that core action that you wanted that group to take continues indefinitely, right? And you don't hit zero really quickly. Now, again, these proxy metrics that you build should support your long-term retention goals. And you're gonna need some sophistication in how you're looking at the cohorts of users in your model to be able to even do this stuff, right? Because you have to have some data that you're strategically tracking along the way. Now, again, if you can't figure this out, then if you have questions on how to think about this, then reach out to me. I'm happy to talk through this because this is a fairly advanced concept. But if you do have this data and you plot it out and you're starting to see those that growth curve flatten, then you're gonna probably in a spot where you can actually measure some of that retention. All right, so kind of the blow through there. But now when we think about cohorts, again, everything that I've been talking about so far has been based not on like a blended view of customers looking back over the last 12 months. There's value in kind of looking at that in aggregate, but what I'm really talking about is taking users it's usually by sign up month or the first time they really engaged with your product, put them into weekly or monthly cohorts to measure what are they doing over time. And to do this, again, you need a little bit of sophistication in your model. The way we do this at GrowthU is it's very manual still. For every member that signs up, we'll try to track back to the source where the member signed up from. And then we'll track that member over time. And we've got a couple different ways we look at this in spreadsheets. And basically, we group January together and February together and March together. And we form this cohort view that says, well, after 3 months, the people that came in January did this, and the people that came in February after 3 months did this. We start to really understand what's happening to our business over time. Because if you look at the blended version of that report and you look at the average of what everybody's doing, you miss the highs and lows in your model. So cohorts simply are just people grouped together based on some criteria. Again, it may be average revenue per paying user over 12 months who signed up in a specific month, and you plot that. Or it might be looking at all the people that signed up in a month by channel. So show me what happened to all the people that showed up in January from Facebook versus all the people that showed up in January from Google. What happened to them 6 months later? How many of them are still around? And you can start to look at that and you can start to make real decisions on your growth strategy based on that. Now, again, I kind of hit on this a little bit earlier, but why do you look at cohorts? Because the averages hide the good and ugly sides of your activation and retention model. So for example, you might be seeing amazing retention from one cohort and horrible from another, but your average retention may look really worse than it is. So like just the way that the data works is that if you don't start to separate it into these cohorts, you get this weird blended view, and it's really hard to spot issues, right? So you're going to need to run this on your own to really understand what's happening in your world. But oftentimes looking at cohorts is going to give you some sense of other weird outliers too. I mean, a good example for us is we ran a free trial I think it was in May. It's in May or June. Might have been June. And the retention off of that cohort is noticeably different for GrowthU. It's significantly less. It's really the only area where we had a churn problem in the history of the company so far is what we could attribute back to the free trial when people came in and didn't have as much incentive to actually participate in the programs and consume the content. And we killed that off relatively quickly because we found that it just wasn't working. We would not have been able to spot that without plotting this on a cohort view. Simple example, this is just pulled from Google Analytics. So you can look at, show me what's happening for 10-week user retention. This is like an out of the box report. Now notice what's happening here. I've got very, very low engagement starting in week 2 and week 3. July 26th, starting to show a little bit of progress here by, week 1 is 12%, whereas this July 5th week was 1.83. August and beyond, we're starting to get better in terms of the percentage of users that are sticking around in week 1 and week 2. But these are pretty bad metrics. And this is actually real data from a little over a year ago. This was from the original cohort of Growth U. Figured might as well share how bad some of the data looked at that point, even though some of the external facing metrics looked really good. Revenue was strong, but this engagement looked bad. But then we took a deeper look and we said, okay, well, what happens if we just pull out the people that were not just first time users that bounced? All of a sudden we have a week 1 retention metric of 46%. Remember on this slide back here, it was 12%. We quadrupled that. So if we learned that if we can just get somebody back one time to the site and consuming some kind of content one time, then they're going to come back over and over and over again. And we looked at this as a cold start problem. So look at who is churning and who is sticking around, and then look for areas of improvement. And then look at what changed during that week of, in this case, July 26th, when back here, we started to see, you know what, something's happening. They're getting a little bit more engaged even early on. It didn't lead to a strong retention, but what did we do? What changed in the product then? What did we change with our messaging? Did we send more emails? Did we send fewer emails? You start to get a signal based on that. And then when we look at, okay, well, how do you plot the monthly cohort? Does anybody here, I guess show of hands, does anybody have a report like this for their business yet? Just in the chat. Okay, a lot of heads shaking no. So I sent, okay, Danielle, you do, right? I sent a screenshot of our version of this to our investors last night when doing our October investor report. So if you're raising money or you're planning to raise money or you have investors, one way to build a lot of trust is to show screenshots like this of what's happening in your product with your real data, because it gives them the knowledge that you are on top of your game and really understand how to track this stuff. And sometimes that's the difference between really convincing them that you know what you're doing and not, right? And so and Joshe, that report that I showed in Google Analytics, I think is in the user behavior report. If we've got time at the end, I'll try to pull it open real time. I don't know if we will. The next thing to do with these cohorts is to plot. So this slide shows month 0 is new customers that signed up in that month. Okay, or new users that signed up, new customers, however you want to measure it. So the raw number. And month 1 is how many of them are still around at the end of the next month. And in month 2, it's at the end of the next month. So the way to read this is that, let's look at February. February, 650 people started in February. And in March, month 1 month later, there were 350 left. In April, there were 275. In May, 225. Then what you do is you plot those metrics as percentages and you get a sense of what your retention rate is. So your churn rate is just 1 minus whatever that last number is, divided by the number of months, right? So there's a calculation that you can run here. But what you want to start to see is that, okay, well, April and May, all of a sudden, month 1 retention, 90% and 95% of my users came back, versus in January, February, March, at the end of that second month 1, 70%, 53%, and 67% stuck around. This is a very strong signal that you're onto something, that whatever you're doing in the product or whatever you're doing with your marketing or activation is working at getting people back. Okay, that's how we look at these things. I'm going to hit play. There's a bunch of stuff here. This is a minute long. Can you just thumbs up if you can hear the sound? Whoops, let me go back. Things to look at for LTV. First of all, you're going to have your new users, whether that's a subscription or consumer. It's the number of new people coming into your starting month cohort. So April users, for example, here, 500 came in month 1.
And then just like with retention, you look at how many are left. But for LTV, what you're going to then do is map the revenue to that. So April revenue, if my unit economic is $10 per user, my April revenue is 5,000. So obviously that's the 500 times 10, so 5,000. And you track that over the next series of months. And then what you can do is you can build a 3, 6, 12 month, whatever interval makes sense for you. You can build the proxy LTV model that basically aggregates all of the revenue from a month based on the sign up month across all of the rows, divided by the number of people that came in during that month. And then you start to spot your trends over time. So this is a really fast, relatively easy and straightforward way to start to build out that LTV model, which may take you 1 to 2 years.
Okay. So the takeaway there is that like, this takes time, but you want to start to get a sense of what that early indicator of your lifetime value is going to be. And again, look at your customer acquisition cost and try to model out, how underwater am I? Or when do I get to profitability on my spend? And again, we're tracking this very, very closely at GrowthU. Anybody that's raising money is going to look at that really closely. But if you're bootstrapping, it's also probably important, right? Because if you're spending some money on paid acquisition or you're spending your time on driving leads, you want to start to quantify what that 3-month, 6-month, 12-month view on that set of metrics, the revenue side of metrics, is going to be. So I'm going to keep rolling, charting retention. This is just an expanded version of the original product market fit slides that I showed earlier. And this is kind of like what this typically, well, not typically, because every situation is unique, I guess, but what it could look like over time, where as you go longer into your life cycle of your product and your product is getting better, your retention gets better. Your product retention gets better. And you notice here, if the retention curve flattens more slowly in April and May, you probably feel pretty good about those product improvements, those features maybe that you added, et cetera, et cetera. But just be mindful that it might be too early to tell what's going to happen in 6 months or 12 months. So you really just have to keep a strong eye on this. These charts are some of the things that I obsess the most over within GU. Early on, it was like, can we find customers? And now it's like, how do the actions that our members and users are taking impact retention? And what are the things that we need to do to drive more of those things, right? And we build our model around that. Okay, so what causes retention to change? Pricing. I mean, pricing is a really interesting thing to look at, and we could do a whole session on pricing. We, at some point down the road, we're probably going to do something on pricing, but it does have a huge impact potentially on retention. By the way, it might be that your price too low. It could be that your price too high. It could be marketing, it could be product changes, it could be the market changing, it could be competitors. There's a lot of things that cause retention to change. So just be mindful of that. Like, there are a lot of different indicators here. The closer you can get to your data, the more conversations you can have with your customers to understand where they're getting value, the stronger your model is going to be over time. Okay, now we're going to look at CAC and LTV. So the other way to look at a lot of this stuff is by retention by channel. And so here are 3 different examples of 3 different channels: Google search, Facebook, and then referrals. Just take a quick look. Okay, so what's going on here? So Google search is super high intent, strong retention, and I would say that we're at product channel fit. So those users from Google, they're sticking around. Facebook, turns out we had a 2-month free offer and then users left. So they stuck around for 2 months. When that offer was up, boom, they're gone. And referrals just didn't seem to be working. I would consider this to not have product channel fit. However, there's a lot of variance. So if you showed me your chart here, the question I would then ask is, well, how much did you spend? And how did you get those customers, right? So there's a lot of variance. So Google happens to be very, very, very expensive. Referrals were quote unquote free, but there was a cost, like if you're incentivizing either side of the referral chain. And then Snapchat was really cheap here, right? So what you need to think about is, how does the cost of the channel look against the retention that you're getting from the channel. And then you'll be able to plot something like this. It would look like something like, okay, well, CAC and new subs by month. So my customer acquisition cost is going up and down, and then the number of users is going up or down based on that. And you start to build a model that gives you some kind of conviction on what channels are worth it and what are not working. So why does the CAC fluctuate? Well, because better audience targeting, for example, might have lowered my customer acquisition cost for 5 months in a row. Boom, 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 boom. But then in this case, we're looking at some of the data around COVID. COVID impacted general marketing spend, that there was less competition. So marketing spend dropped, which brought the CAC down. But then June and July saw a huge increase in spend. Again, competition comes back in, pumping money into paid acquisition channels. And then your business is also impacted as a result. This is a very real thing, right? The Facebook iOS 14.5 issue, right? Some of the tracking issues, like all of these things are impacting CAC and will be one of the reasons why your CAC fluctuates. But going back to the example of these 3 different channels, the next thing you want to do is look at retention by channel against your payback window, right? And you get that by dividing your customer acquisition cost by revenue per month or transaction. And so for Google search, it cost me about $245 to get the user in the first place. At $30 a month, that means that they'd have to stick around for 8 months. Well, the good news is that like most of my users from Google stick around, right? That's what this shows. And so we feel comfortable spending versus like, let's say you're spending $300 on referrals to incentivize the referral chain, give 150, get 150. Well, guess what? I probably would kill off the referral campaign because those users are gone after 3 months and you never make that money back. Right? This is the honest view of like acquisition. If you can get to this point and you can segment based on these types of indicators, these channel-based indicators, and you're truly looking at channel to payback window, you can have that honest conversation with yourself and with your team around where you should go spend time. Right? So in this particular case, if you showed me this data, I'd spend money on Google all day long, even though it's a lot more expensive because the retention is so much stronger. Okay. And we'll definitely have time for questions afterwards as well. So for LTV, again, what I'm looking at here, LTV, lifetime value, is also a long-term metric. It's generally over a year. So break it down into those 3 and 6 month and 12-month intervals. And your 3-month revenue, so what's shown in yellow here is like positive, what's shown in red is negative. You want to see that 3-month revenue going up over time, meaning that the users are coming in that month, are spending more money in that month, in that first month that they're with you, than the users that came in earlier. If you see that, that's a healthy trend. If that's dropping, that could be a problem. By 6 months and 12 months, you definitely want to see that increase over time. And spot trends, like if you plot it this way, this is literally what we use in for our investor updates and when we're looking at LTV. Because one of the things that we're trying to figure out is how much can we spend on marketing on a unit basis versus how much are we going to get in return on LTV. And again, being relatively early stage, we don't have all the answers yet, but we're starting to see some really interesting trends happening in our data. And I bet you will too if you plot it. So yeah, just some of the quick takeaways: leverage those activation curves with retention charts to determine whether things are getting better, look at acquisition by channel, measure those payback windows, and keep rolling. This is the final section here, and there's kind of 6 ways that I've thought through how to improve retention. I'm sure there's more. We're going to dig right in. So this is areas to improve, ways to improve retention. Number 1 is spend time focusing on new users. Okay, love this quote. Actually, this is not the quote yet, but you can't teach an old dog new tricks, apparently, right? But when you've got users that are used to a product, it is very hard to reset their expectations of value. But you can leverage experimentation and use those proxy metrics as an indicator of success. When we're looking at early customer focus, right? This is a quote from Dan Hackemeyer, who does a lot with Reforge, saying just how almost every big lasting retention win came from improving the early user experience. I mean, think about that for a moment. All of the lasting retention wins came from changing the early user experience. It's that first impression that your user has. So here's just a few ideas, right? We can do a whole workshop on this, but here's some ideas. Personalize the onboarding, offer more relevant content to the people coming through your flow. Run drip campaigns to help users qualify themselves better. Do some of the stuff that we looked at that Miro did with onboarding. Personalize the onboarding experience. Offer different products alongside your core product to see what resonates. These are all different things that you can do early on that you can get a measure on in terms of how does that change my onboarding? How does that change the perception of that early, that first initial experience that the user has? Change that messaging and frequency, activation flow, onboarding. We're doing this all the time at GU. A lot of the high growth startups that we're seeing are doing a lot of experimentation on things like onboarding activation until they figure out that they've really truly cracked the code. And then they move into kind of less risky experimentation almost forever, right? They consistently experiment and iterate. So just know that like making these changes though is probably not going to be an overnight thing in a lot of cases, right? There's only so much that you can pick off that's going to be just like really fast for you to do. I'm not going to get into a lot of these details, right? But like taking any of those ideas that I threw out there means that you need to go and execute on them in an experimentation driven way, which we'll get into next week, right? And there's work that's going to have to happen. And so if you've got a brainstorming session with your team where you come up with 3 or 4 ways to change that onboarding, for example, figure out like where in your roadmap that lives and just be willing to put in some work to get the work done, measure the impact, and then modify. And you want to look for certain signals. So whatever hypothesis you had coming into making a change with activation or onboarding, go back and report on whether or not the user did change their behavior because of the things that you did, right? Did that user improve? Did it stay the same? Did it get worse? Did your metrics get better or worse? And then you kind of go through this process over and over and over again. And we kind of look at this on a weekly basis with our company because we found that like we have to try a bunch of different things to really understand what is going to resonate. Those of you that have been around a lot longer, maybe there's some areas where you definitely want to avoid going or things that you've tried that you don't want to repeat, but you'll always be in this process of experimentation. And remember to look at cohorts, right? So you can run as many experiments as you want, but if you don't track the results of those experiments by cohort, then you're going to lose the signal in terms of what worked and what didn't work. It's just going to get blended in with everything else. Okay, the next thing you could do is just target better users. Way oversimplified, but not all customers are your ideal customer, and that's okay. Not all channels will drive your ideal customers. And if you see a chart like this, after you spent, months working on your beautiful referral campaign, that 3 months later you realize was a total disaster, that's a problem, but it happens, right? Just be open and objective when you're thinking about these channels, because really anything could work. Sometimes the value you provide to get a user in the door is not enough to keep them around. You see this a lot with discounts. We saw that with our free trial. And it is much, much, much easier to leverage things like discounts or offers to get people in the door. But that could also have a negative impact on retention. And I saw this really firsthand at Upside Travel, where our CAC was north of $2,000 when I came in. We ran dozens of experiments to lower it. We ended up, we're a business travel startup, so we ended up giving away Bose headphones as an incentive to get in the door. I mean, it scaled like crazy. Drove CAC down by 5x, which met the goal. And that was what I got hired to do. And that was like very successful. However, we got written up and things like this. However, look at our CAC by channel drop and our new user acquisition, but then look at our retention. So one chart looks amazing and you feel like you're on top of the world because you cracked the code on acquisition. And then you look at it 3 months later and you're like, oh my God, that was just a complete and utter disaster. And it was, and we turned it off. All right, because users went back to their old habits. The offer was great to get them in the door, but with our product, we needed a lasting relationship with the user, because that's what our retention model was based on. And the business impact was bad. Okay, next thing you can do, provide more value to your users. What are you doing to make your product better, your messaging more clear? Are your features that you're building actually adding value? Are you connecting the majority of your users to additional value by adding a feature, or are you just making your product more bloated, but you feel good? I hate to be like negative about it, but you feel great building products or building features that don't actually matter, right? And that's the trap that a lot of us get into. And when I talk about failure, I talk a lot about that aspect of product management, where you're building stuff, but it doesn't actually matter. So where do you look? Find areas of deep engagement and try to provide even more value. Go deeper in the stuff that's working. Find areas of low engagement and try to improve that experience. So opposite ends of the spectrum here. Make sure that your users understand that value that you provide. Product marketing. Product marketing is really hard, but that's an area of focus a lot of times when we want to think about how to provide more value to the user. Sometimes it's connecting the dots for them. Example here from Sandbox, where we found areas of deep engagement around content, and we provided a lot more value through additional content. And this was a business changing decision in a positive way. Like, we spun up a whole media company within Sandbox to produce content, to share that content and get it out into the world. And we built a newsletter and we put all that back into the app. And what it did was it furthered the engagement, the proxy metric that we had, that speed to value, and it dramatically increased our metrics. You might also need to remind users of value more. Robinhood, I mean, had to throw it in here, but like, you know, they are very good at reminding you of the value that you can get by using the product. You can show value sooner. So this may be removing onboarding steps. It might be replacing request a demo with access to the platform. It could be replacing a static image with a 30-second video. Talk to churned users, right? This is like really critical. It takes a bit of a thick skin to do, but if you talk to your churned users, you're going to really understand why they left. What value were they not getting? What expectation did you set that they did not get value from? And as much as like I hate to see like members churn, the learnings from that are actually really, really valuable for us, and use that knowledge to your advantage as you move forward. Next thing, kill features. You know, when we think about product management and feature development, a lot of times the loudest stakeholders get what they want, and that is usually bad. The best product teams that I've ever seen at the fastest growing startups or the most well-run startups are absolutely brutally relentless about prioritization. And they learn to very nicely say no most of the time. Because again, we're biased towards action. But a lot of times, like, you want to think through, does this thing provide enough value? And the problem with too many features is that they become dead endpoints for your users. So I look at it from a 90% rule. What features are 90% of your customers using all of the time? And what features are being used less than 50% of their time? And are you getting your users confused? If you see that there's areas where almost nobody's using it, you may use this mindset to prune some of those features out. I mean, again, I talked through the struggles of overbuilding early on in week one. Like with Votion, I mean, we overbuilt and it almost killed the company. And then we scaled back. We actually killed off all of the hard work that we had done. And guess what happened? Revenue picked back up again. Super painful lesson to learn. Do more to activate your users. And this is just basically like, you know, try harder to connect your user to value. Sometimes you just need to do more. Revisit that activation flow. I use this example of Miro. This is what I showed in week 3 for activation. They kept going. And there's some that I didn't read, but I read a lot of them. The point is that they're trying. They're trying to stay top of mind. And, you know, the other thing you can do is like more personalization. In early days, The bottom left here is like an early iteration of the Growth U email that would go out. It's almost embarrassing to read that now compared to where we're at now. Marcus Jones said switch to a no credit card flow and free trial. Now we don't have people canceling their first 30 days after getting auto billed. The ones who sign up plan to stay. And then this was a Votion email here. This was like, literally we would handwrite these things. We had a template, we would handwrite them, but it took all of this to kind of get users to understand the value and to get them to stick around and to get activated. Watch what Netflix does. So I'm on the homepage, and it's come through a couple iterations since I did this recording, but scroll down and I hover over something. Boom, it starts playing. Why? Because they know they need to get me in consuming 19 hours of content. So they build their whole experience around that. The whole thing is based on me spending 19 hours. And then change your pricing or model. This is sometimes counterintuitive, but changing your pricing could be the fastest way to get your users to stick around longer. And it doesn't always mean lowering the pricing. Pricing is often very arbitrarily chosen. And so the question I would ask yourself is, why did you pick your current price? Are you on no free trial or freemium? You could try one or the other or both. Are you requiring a credit card before your trial? You could try to remove it and test. Do you have a transactional model? Try a subscription. We built a subscription within Sandbox. Sandbox was around for like 7 years. Nobody ever thought there'd be a subscription there. We built a subscription. It was not an insignificant part of revenue at the end. A subscription model, try adding some transactional stuff, right? Nothing free, give something away for free. Any of these things, right? Just so to wrap it up, like general guidance would be focus on retention early, know those metrics, build features to support retention. Don't try to scale until you're at product market fit. Keep trying to improve retention. It can be done, but it takes focus and it takes work. But it's probably that most important part of your business.